Hey, Rainbow people, it's David.
And John.
Tariffs, trade wars, treasury dumping, and now real war. So, what the is an investor supposed to do right now?
On Queer Money episode number 637, we sit down with Optimized Investment Partners CEO Pedro Lino to break it all down. Queer Money is brought to you by Optimized Investment Partners. More on that later.
So let's get you clearer, more confident, and positioned for what to expect in this crazy market. Well, welcome back, Pedro, to Queer Money. We're so happy to have you on the show again.
Thank you so much for the invitation. It's a pleasure to be here once again.
Definitely. So let's kick off this conversation. If you had to sum up today's global economy in one sentence, what would you say?
I say that we are in a resilient but politically fragile economy, meaning that investors should be very careful and take a look at collective opportunities, because in these days they cannot go through blind confidence. So you must be attentive because things change very, very quickly. In 1 hour, we can have the oil prices skyrocketing 10%. In the next hour, going down 10%. So very careful.
Yeah, definitely. I would agree with you on that one. We're recording this the morning that it was announced that the war is going to be extended. And I looked at oil, and oil prices were up 7.5% today. So it's quite shocking, I think, for a lot of us getting this back and forth with the market. So would you say investors should be nervous right now or optimistic?
Look, short term, there is a lot of noise. Like, for example, last year with the tariffs, we had 30% drawdown of the S&P 500 since February to the beginning of April. But at the year end, everything seemed perfect. So these are events that on short term, they create lots of noise, uncertainty, and even afraid among investors. But long term, if we take a closer look at the economy, we are on a shifting, tectonic shifting world where, we have friendshoring, meaning that those countries that are friendlier, more friendly of the US will have less trade barriers, and the ones that are against will have more tariffs. So things are changing towards more protectionism, towards a less globalized economy.
So folks, if
curious, real quick, I'm curious, do you think this is is this the new normal, living in this cacophony of noise that we need to start to navigate going forward? Or do you see this as sort of temporary?
Well, for sure, till 2029, it will be very volatile because it has everything to do about politics. If you, depending on who is in charge, things will keep like this volatile. And what we are seeing is a shift from globalization, another world that we still don't know what it's going to be, but it's going to affect all of us. And what you need to understand is we have to do an assessment in our lives, in our financial lives, personal lives, and understand what we will want in 10 years. A second residency, diversification, another type of portfolio, what we have to do. So it's a time that we have to think not only on the short-term noise, but mostly on the long-term, what we want for us.
Definitely. So folks, if you're watching us on YouTube, drop us a green heart in the comments if trading in this stock market has you a bit nervous. So we appreciate your comments there, Pedro, about the volatility, a lot of this having to potentially be political and depending on who's in charge. And we know that for those of us in the for those of us in the United States, it is kind of scary because this is where a lot of that noise is coming from. So would you say that this is something that we're going to see for a short term or a long term? I know you just mentioned 2029, but do you think that globally that we might see more of this kind of thing happening?
Yes, I do think because conflict, we have lots of pending conflict in the world, and actually they are not being settled definitively. So we had Greenland, Venezuela, Cuba, Iran, Taiwan, Russia, and Ukraine. So there are many sources of conflict in the next couple of years. But what the market is saying is that interest rates are going higher because inflation expectations are also going higher. So what people are taking a look at, and specifically the investor community, is at the supply chain that is being disrupted around the world. We saw that in the pandemics in 2020, then in 2022 with the war in Ukraine, and now with the Strait of Hormuz and the Red Sea almost closed, which account for almost 36% of the world commerce. So this is going to have real implications in our lives, meaning inflation is going higher, interest rates are going higher. For example, in the US, it was supposed at the beginning of the year, the expectations were that interest rates could go down 75 basis points. Currently, the expectation is 0. We knew the expectation was to maintain the interest rates at 2%. Now, the expectation is to go up 75 basis points. So this war is going to have a huge tool on consumers regarding inflation, but also the ones that are in debt because they will pay higher interest rate costs.
Yes, definitely. I appreciate that Pedro, this whole idea of things continuing long term is something I think a lot of investors should be aware of. Based on that, is there one risk most investors are completely underestimating right now?
I think, yes, the liquidity risk. And you're seeing that on private equity, that many funds are suspending redemption. Biggest underestimated risk because it can disappear in a matter of seconds. And what we're seeing is that passive flows are dominating the picture. And when those flows disappear, the liquidity drops. And it happens in the open market, but also in the private equity, because as uncertainty rises, money doesn't flow anymore or flows at a lower speed, and that affects both private markets and open-ended markets. So very careful about the liquidity, because these days the diversification is not what it was. And what I mean by this is, as interest rates are going up, bond prices are coming down. So if you're trying to diversify from equities to bonds and you think that the 60-40 portfolio will protect you, in this kind of environment where energy prices are going up, inflation up, and interest rates are also going up, on this type of environment like 2022, everything or almost everything drops. We saw gold dropping, bonds dropping, stocks dropping. The only thing that is up actually is fire. So careful with diversification and the liquidity, which I think is underestimated risk.
And I appreciate that you talked about the private equity point there, because that is something that the current administration is trying to push into 401ks for U.S. investors. So please, folks, be careful when it comes to private equity in your 401ks. So to be honest, are we at a point where...
Just to mention, look, private equity, people have to understand that with higher returns, you'll have also higher risk. So the promise of higher returns also comes with this potential problem, which is suspending in the redemptions, and you cannot liquidate your assets.
Right. I agree. I actually saw a news story this morning about Blue Owl and the massive amount of redemptions that are coming out of one of their funds. And they're having to basically tell folks, sorry, but you can't take your money out, or you can't take out as much as we thought. So that's
scary for everyone.
Yeah, that is a very important thing to keep in mind, that with the higher returns does come higher risk. So please be careful. So to be honest, then, are we at a point where being 100% invested in the U.S. is actually risky?
Well, I think it's risky because of over-concentration in megatech stocks. Last year, more than 37% of the S&P 500 index was concentrated in 10 companies, and the majority of them were technology. So I think that there was high valuations, although with this recent correction and in some technology companies, they are more acceptable PEs instead of 30-something or 20-something PEs. But still, when comparing with other markets, the US market is still high. And we saw last year that the US markets underperformed almost all stock markets, not only in terms of price appreciation, but also due to the dollar depreciation. So, for example, last year the S&P 500 was at around 8%. European markets were at 12%. Back, the dollar was down 14%, meaning that actually the US investor lost money if you take into comparison the purchasing power. Although you see the S&P 500 is going up, when you convert into euros, actually you would get a loss. And if you were invested in the European markets, you would be up 12%. So be careful because you have also to take into consideration the dollar depreciation. And I do think that an economy that now is reaching $40 trillion in debt, and especially now that the interest rates are not going down anymore, we might have some problems in the way.
Yeah, we have a problem.
I think
I don't want to be scary, but I think diversification and look, I'm not saying tell US and get out of there. No, I think that the US trade was very overcrowded. So if you take a look here in Europe, everyone has a S&P 500, Nasdaq 100. Everyone was looking at the American markets. But now, even with the European Commission trying to create some incentives for Europeans to invest in European markets, I think that potentially part of them, that money will come back. And even with the dollar depreciation last year, many US investors are now investing in euros to diversify their portfolio. So I think it's a very good strategy. And so the risk of investing in the US market over the next couple of years, at least in terms of being an outsider, a foreigner, it will be higher due to what I think is going to happen, which is dollar depreciation.
that makes sense. So question here, if I'm a US investor and I'm living off of dividends and bonds, which you just kind of highlighted that there's potential more risk on that side, do you have any suggestions to diversify away from the US and still generate income for me to be able to live off of?
So on the short term, you need to be exposed into shorter term bonds, meaning that you have to wait until interest rates go up or stabilize, and then you can increase the duration of the bond portfolio. So the only way to protect in this kind of environment, where interest rates are going up, inflation up, energy prices up, is to short your duration on the bond. And that comes with sometimes a sacrifice of return. So you do not receive 4%, but you accept to receive 3% in 6 months or so. And I do think that in the next 6 months, we will have more visibility and people will get higher interest rates in investing with higher security. Regarding the dividends, there are funds and ETFs that accumulate, that invest in high dividend yield companies and are accumulation funds. Those, I think, are still good investments because the companies at the end, they are the ones that will be the winners, because like we saw in 2022, where we had the inflation, then the companies, they took some advantage. They managed to increase their margins, their sales, and at the end, those companies that already pay very good dividends will keep back. And I think those funds and those investments might be a very good idea.
I hope you're right.
Yeah, I definitely agree. Are there options for someone who may want to move some of their assets outside of the US and still be able to do that?
Yeah, there are European ETFs that invest in high yield bonds or investment grade bonds, or in terms of stocks in high dividend yield stocks. So you can take advantage of that, and also investment funds. So there are investment funds that invest in our case, we have one in Portugal, but you have several where you can invest and take advantage of those high yields on stocks and bonds.
And so if I was an investor who, say, for example, had access through a broker in the US to be able to purchase funds like that, ETFs like that in Europe or in Asia, that's what you would suggest then, is that you would actually go through that process of actually purchasing in those currencies rather than purchasing them through a broker with US dollars?
I think that it's not possible for US clients to invest in foreign funds through, for example, Vanguard or Fidelity. What you have is funds that are exposed internationally. Mm-hmm. So they have international exposure, but they are listed in the US. If you want to buy a European fund, like a UCITS fund, which is a European directive of funds, then you should have an account in Europe. And like this, you have dual custody. You have the custody in the US for US shares or securities, and then a European custody for European funds or European securities. But you would have to open an account in Europe and be direct exposure to those kinds of funds. The alternative is to buy through a broker in the US a fund or an ETF that is listed and created there that has international exposure or without currency hedge.
Right. And this seems to be something that wealthy investors are doing right now. It seems like they're diversifying across countries, not just their assets, but it seems like they're also doing this with where they consider to live. Is
Right.
that?
And we are seeing that. We are seeing, we currently have more than 700 American clients. And what we see is that they want to diversify everything. So they are planning for the long term. They want to diversify their residency, their investments, and their goals in life. Also, they want to have plan B. And regarding the residency, many of them are looking to Portugal, not to move straight away, but on a longer term path. So they want to be able to stay here 6 months here, or to have their kids study in Europe. We have many motives. But regarding the investment side, they are also taking advantage of this to diversify from dollars into euros and into a European fund that actually is getting very good return over the last couple of years. So they are planning long-term, and you are correct, diversification regarding citizenship, residency, and investment.
I would
That's what the wealthy are doing.
I would love to get your outsider take. We know this trend started sort of after the pandemic, but it really escalated in 2024 to diversify so dramatically, not just your investments, but with where you're going to live or where you consider your home. From an outsider's perspective, non-US citizen, what do you think is the catalyst for all that? What has changed so precipitously that so many wealthy are trying to diversify so dramatically?
In one word, politics. This is the key word. Politics, politics, politics. Everything changed in the US, in Europe, and after 2020, especially 2025. 2024, we saw already with the pre-elections in the US that many Americans were trying to understand better the Golden Visa program in Portugal. We saw a huge increase, spike in demand, but especially after the US election, the demand skyrocketed because people just want a plan B, as I mentioned, not to move straight away, but as a long-term planning.
So you mentioned the Optimized Investment Partners Golden Opportunities Fund, the Golden Visa. And so maybe you could tell us, how does that fund help our listeners diversify away from the US? And what are some of the perks of investing in that?
Optimized Portugal Golden Opportunities Fund is a fund that invests at least 60% in Portuguese stocks because it's one of the criteria that makes him eligible for the Golden Visa program. And the Golden Visa program is a residency by investment. So you invest at least 500,000 euros in an investment fund that is eligible for the visa. Then you have a temporary residency after you get the permanent residency card, and then you can apply for the passport. But with the temporary residency, you can stay at 365 days. You can live 90 days in the other European country that belongs to the Schengen area. And with the permanent residency, you can stay 365 days in Europe without any problem. If you stay one, you have also access to healthcare and everything, public healthcare and education. The fund has to invest mostly in Portuguese companies, stocks and bonds. So our weights are 75% stocks, 25% bonds. And so far, the fund has 4 years and 3 months. We have returned more than 14% a year. To be honest, I expect going forward around 7% would be very good. And one of the specifics about this fund is it's an accumulation fund. And the Portuguese companies, because it is a small market, they pay very good dividends. And we keep compounding the dividends and the coupons that we receive from the bond. That's why on the long term, you see this compounding and the results of the funds are really. In the case of US clients, I would say that 1/3 of them, they are using their IRA accounts to invest in the fund because it's a way of diversifying from dollar assets. They are buying a fund in euros through their IRAs, and it's a way of using their retirement funds to invest in the fund. And that if they want, they will be able to come and also live in Portugal, but it's not mandatory. Basically, we have clients that use their IRAs to diversify, others that are also take advantage, and then they will decide if they want the Golden Visa or not. The fund, regarding the perks, it has no redemption fees, so it's daily there's daily liquidity, daily net asset value, meaning that if you no longer want to invest in euros, you can redeem the fund without any penalties. And also there is no performance fee. So actually what you try to create is a very simple, liquid and transparent instrument for people to invest, to diversify their portfolios, and with a great.
Yeah, gotcha. And I know you know this, but some of our listeners and viewers don't know it. You mentioned earlier that you have about 700 American investors in the fund. We're in the process of making that 701. So we'll share more about that as we get further down the process. I think right now we have to get our background check, which could be the biggest hurdle we have.
You never know what you have with the FBI.
Yeah, I don't know what I've done before.
So just two add-on questions, maybe you can answer there. Well, first of all, I appreciate that you shared that you can do this with your IRA assets, because for many Americans, that's their largest asset. It may be even more than their homes or either their home. And so for a lot of folks, being able to invest that amount of money, it may have to come from an IRA account. But also, I'm aware that the fund doesn't have a requirement of investing 500,000 euros. So someone who doesn't have that 500,000 euros can still diversify by investing in the fund, correct?
Excellent question. So the fund is not only for Golden Visa clients, it's also for Portuguese clients. Me and my mother, we are investors in the fund, and almost everyone at Optimize. So the fund starts at 1,000 euros, meaning that with 1,000 euros, you can start investing in the fund and diversify your portfolio. So yes, it's not mandatory that you invest 500,000 euros. You can just diversify. And as I mentioned, we have many clients that are also using this Golden Visa eligible fund, not for Golden Visa, but also for diversification purpose. And yes, you can invest lower amounts.
Yeah, I think that's an important
with the
point.
Same benefits.
Right. I think that's the important point, is that some folks may still want to diversify, but may not have the ability to put all 500,000 euros in there. So our last question for you here: if you had to reposition your typical American portfolio today, what would you change first, and what would you absolutely not do right now?
What I would not do is panicking. So we know that there is a lot of short-term noise. I would not panic, because we saw already good correction in the US markets. And a couple of days ago, we saw a huge rebound. So be very careful with the rebalancing of the portfolio, which is what I think American investors should do. So the American trade is really crowded, and Americans majority of them were always investing in America. Try to diversify from outside the US, but do it slowly. You don't have to change 15% of your portfolio in one day or 50%. You can do 5% at a time and try to understand how you feel about investing in foreign markets. And you have very good funds, ETFs, that where you can get international exposure to European companies or emerging market companies also. Of course, that emerging markets come with the higher expected returns and also higher risk. Europe, we have less returns, but also a lower degree of risk. So everything is a balance.
Definitely. Well, thank you very much, Pedro. We appreciate this conversation today, helping maybe calm some nerves or giving us some options for calming our nerves when it comes to investing.
No, thank you so much for having me here. It's a pleasure.
Thank you, Pedro, and thank you all for listening and watching.
We have an interesting episode coming up about why you actually may end up hating retirement. So make sure you're subscribed and join us next time. Meanwhile, stay fabulous.
Not fabulously broke. And if this interview with Pedro Lino, a Portuguese man, and us two Americans sounded a bit like Greek to you, maybe check out this video here on the top 10 investing terms that you should know.